Welcome to the Stock Market Palantir. Today we are going to talk about JELD.
JELD-WEN holding, that is. And what a story. This is a company that has been absolutely decimated. We just saw this violent repricing of their equity after the catastrophic third quarter 25 earnings release.
Yeah, catastrophic is the right word. I mean, a 13.4% year-over-year drop in net revenues. And they had to slash their full-year guidance dramatically.
Right.
The market has, completely moved beyond pricing JELD on traditional metrics. The stock is now trading purely on solvency risk. So if you're looking at JELD today, you're essentially buying a highly leveraged call option on the company's ability to just survive.
Which brings us to the core debate. Can their big plan, the strategic review, specifically selling off the entire European segment, can that actually fix their incredibly precarious capital structure?
Or is the distress just too deep? The operational and credit crisis is, it's made terrifyingly clear by their latest Altman Z-score. It's sitting at a deeply distressed 0.8.
Exactly. And anything below 1.8 is considered distressed territory. So a 0.8 score is, it's basically the math screaming that the probability of bankruptcy is exceptionally high.
Sure, it's a terrifying number, but I'm going to argue for the potential of that strategic sale. I think it provides genuine option value. If they can execute it correctly, get a premium valuation, it offers a credible, disciplined path to solving that massive $400 million debt wall in 2027 and stabilizing the core North American business that's left over.
And I maintain that the structural integrity is just gone. The magnitude of the distress, the operational collapse, I just think a bankruptcy restructuring is the most probable outcome, regardless of this asset sale.
All right, well, let's lay out the positions.
Please.
So my position is rooted in the idea that the equity market is overreacting to, short-term operational noise. It's ignoring the possibility of a clean financial solution. The value here is that option value, the non-zero chance that management pulls this off. And for this to work, we need what we're calling scenario B, a strategic premium valuation.
Okay.
The European segment, it generates about $1.1 billion in revenue, and it is, relatively speaking, the more stable part of the business. I believe a $550 million valuation for that asset is plausible in a strategic sale.
But that valuation assumes a buyer just ignores the terrible macro environment and the seller's duress. And let me ask you, if the company were healthy, why would they be selling a $1.1 billion revenue stream for a mere half a times multiple? That price already signals desperation.
The urgency is precisely why they must hit that number. $550 million in gross proceeds is enough to fully retire the critical $400 million of 4.875% notes due in December 2027. It vaporizes the single biggest solvency problem, and if they do that, the whole investment thesis shifts overnight.
A very big if.
But there's more. The market is completely ignoring one really compelling contrarian signal: the recent aggressive insider purchase of over 115,000 shares by Rachel B. Elliott, the EVP of North America.
Wait, hold on. An EVP is buying over 100,000 shares after a quarter that bad? I mean, that sounds insane. Are we really supposed to read that much into a single insider signal?
It's the highest conviction signal you can get. It suggests deep internal confidence in the North American turnaround plan, especially that brutal 11% workforce reduction they just did. It's a statement that management believes the remaining entity is actually viable.
I'm sorry, I just don't buy that the sale will be enough. And I am definitely not convinced by one insider buy. Let's look at the financial decay. I mean, the company is structurally insolvent, full stop. That Z-score confirms it. The operational collapse, it's rooted in the failure of fixed cost absorption, what we call negative operating leverage.
If the layoffs are designed to attack those fixed costs directly.
It's too little, too late to save the capital structure. That 11% volume drop was paired with a negligible 1% price realization? That means they have virtually zero pricing power. They are trapped. They can't pass on costs without volumes collapsing even further. And then look at the balance sheet. Leverage is projected to remain above 8 times. 8 times! That is just an utterly unsustainable level for an industrial company, and the adjusted EBITDA margin has collapsed to a critically low 5.5%.
That is a staggering drop in margin. I will concede that.
And it gets worse. Nearly 40% of their projected EBITDA is now eaten up by interest payments alone. So relying on a single asset sale under these conditions, it's not a strategic plan, it's a Hail Mary. It makes my distressed fire sale scenario A, where the valuation is only, say, 240 to 275 million, far more likely, and that amount is fundamentally insufficient to solve the 2027 debt wall.
Okay, so this brings us right to the core of it, the likelihood of achieving that strategic valuation. I accept that if they only get scenario A, the equity is probably worthless. But why must we assume the market won't recognize the intrinsic value of the European segment?
Because the context matters more than the asset itself. The current depressed European construction market makes achieving the necessary half a times revenue multiple the key assumption behind your $550 million highly improbable. This asset is being sold from an explicit position of weakness. I mean, the rating agencies confirmed it with their B- rating and negative outlook. Buyers know JELD-WEN is selling because they have to, not because they want to.
But wouldn't a strategic buyer look past the current cycle?
A strategic buyer will price the deal based on the seller's immediate distress and the current depressed earnings, which are running at only $40 to $50 million of EBITDA. So you apply even a generous multiple to that number, and you're getting a valuation that lands significantly below the required $400 million, probably below $300 million. They are not going to pay a premium just to bail out JELD-WEN's bondholders.
I see why you think that, focusing on the current numbers, but let me offer a different lens here. The European segment is their stabilizing anchor relative to the chaos in North America. And yes, current EBITDA is depressed, but this sale is targeting strategic buyers, firms like Assa Abloy or Masonite. They're buying market share, distribution, a valuable franchise.
Franchise value is secondary to solvency right now.
But a strategic buyer pays a premium for the normalized earnings potential. Historically, that segment ran closer to 80 to 100 million in EBITDA. They're buying the ability to integrate that asset and achieve synergies JELD-WEN can't. That's what makes the $550 million target achievable. They aren't buying 40 million of EBITDA. They're buying 100 million of capacity.
Okay, even if we grant the possibility of a premium, we can't ignore the severity of the decay in what's left over, the North American business. The market is pricing in the high probability that the remaining company just isn't viable, even after the sale.
I fully acknowledge the devastating 19.4% revenue plummet in North America, that 13% core volume drop. It's a terrible performance. But I emphasize the company is taking decisive action. That 11% workforce reduction is aimed at radically resizing the cost base to match this new lower volume. They're aggressively attacking the negative operating leverage.
That's an interesting point, but I see the North American situation as more of a death spiral. That 13% core volume drop, it far outpaces the general market softening. This is market share loss, not just a cyclical headwind. It signals deep internal execution issues specific to JLW.
But they have to shrink. They're trying to right-size.
But some of the shrinkage is mandatory and involuntary. We have to factor in the court-ordered divestiture of the Towanda facility. That alone creates a structural 5% revenue headwind, and that involuntary loss creates what we call stranded costs.
Could you explain stranded costs for our listeners?
Sure. Stranded costs are just the corporate overhead, IT systems, executive salaries, central purchasing that were spread across the entire company. Now that overhead has to sit solely on the shrunken North American asset, which severely compresses margins even further. It's a permanent drag. And the final admission of failure here is the massive $196.9 million impairment charge they just booked. They basically admitted their own assets are fundamentally overvalued.
Okay, but let's shift to the market mechanics for a second. The microstructure, because I think the data can be misinterpreted.
I think the microstructure confirms the market's conviction. After the crash, the dark pool short volume ratios surged to nearly 50%. That signals massive institutional distribution. Large asset managers are aggressively dumping the stock. This isn't a retail frenzy, this is institutional capitulation.
I agree it's institutional exit, but we need to look closer at the quality of that distribution. The market plumbing suggests the price action is rational, not chaotic. We see very low failure to deliver, or FTD volume, and a low days to cover ratio.
And why is that relevant when the stock is cratering?
Because high FTDs can be a sign of, synthetic short selling that drives irrational moves. The low numbers here suggest the stock borrow market is functioning normally. This confirms the price decline is driven by genuine, rational selling, an orderly exit, not a forced cascade. And that orderly function actually leaves the field clear for a rational rebound if the sale is successful. This isn't a meme stock, it's a credit story.
And that rational selling brings us back to the unavoidable core issue, the 2027 maturity wall. The institutions are leaving because they've done the math on the debt.
Indeed, management has to address the $400 million in notes due in December 2027.
And they cannot be refinanced. Given their credit profile, they'd be facing rates of 10 to 12%. That's intolerable. So the asset sale must repay the debt in full. If the sale proceeds fall short of that $400 million threshold, the leverage ratio stays above 8 times, which triggers covenant tightness. And that would almost guarantee a future downgrade into the CCC rating tier.
For the audience, can you just say why that CCC tier is so dangerous?
A CCC rating means the agencies view default as imminent and highly likely. At that point, access to credit markets just shuts down. A downgrade to CCC is essentially the point of no return. It's a guaranteed restructuring trigger.
I don't think it's guaranteed because it ignores the proactive steps management is taking. The market is pricing in the risk, yes, but things like the interest rate collars on their term loan show they're mitigating risk where they can. And crucially, this strategic review is exactly the proactive step S&P demanded to avoid those further downgrades.
Demands don't pay bills.
No, but their strategy is focused on repaying, not refinancing. That is the disciplined move. They are using the only real asset they can liquidate to solve the debt stack. If they hit that $550 million strategic target, they convert the option value into concrete equity value by wiping out the entire maturity wall in one stroke, before that CCC cliff can even be reached.
That relies entirely on achieving a highly optimistic valuation under maximum duress.
To sum up my view, this entire thesis rests on the outcome of the European divestiture. Given the necessity of addressing the 2027 notes and that aggressive insider buy, I think the company has a credible, though certainly high-risk pathway to becoming a smaller, financially sound, North America-focused entity, and that possibility warrants the current option valuation.
And to reconfirm my stance, the structural problems, the negative operating leverage, the 5.5% EBITDA margins, the crushing 8 times leverage, they just can't be ignored. The company's situation is so precarious with that 0.8 Z-score that any valuation below $400 million on the European assets guarantees a restructuring, making the equity a likely wipeout.
So JELD-WEN really is a classic special situations case study. It forces us to prioritize credit solvency analysis over, traditional operational metrics.
Exactly. It leaves the investor weighing the probability of the strategic premium scenario versus the more likely fire sale outcome.
We've explored whether the strategic divestiture provides a credible path to deleveraging or if the underlying credit crisis just makes a restructuring unavoidable.
We covered the huge gap in potential valuation for the European assets, the critical nature of that 2027 debt wall, the risk of a CCC downgrade, and of course the severe operational decay in the North American segment.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.